Good evening, everyone. This is the 4th of November 2020. This is Rohit Srivastava here, founder and strategist at Indiacharts, taking you through all the market action and what I've been writing about for a large part of the last month. This update is, of course, coming after a while. And what we've actually been through is a long consolidation phase, especially for individual stocks, because when you actually look at individual prices, you see that, prices just pulled back, consolidated, have probably gone through some kind of an accumulation phase and are simply waiting for the next round of price action. So one of the good things is today we will be ending the uncertainty that has been around because of the US elections, and this is the typical seasonal pattern. I thought it wouldn't repeat because at the first week of October you actually ended up getting a rally, and that rally came off an extremely oversold condition at the end of September. So end of September, I took the call that when it would fall into 10,790, that we would start heading up again. I wrote the long short report titled, the last hurrah as we enter into the fifth and final wave of this up move. That move lasted for 2 weeks, a little more than 2 weeks, pretty strong rally, more than 1,000 points. But it lost momentum there. And we hit the seasonal patch because even US equities did have a rally as expected. But the moment they lost momentum, I said that maybe it will pull back in wave C of an ABC correction inside of what the Dow itself was doing and end up following the same seasonal pattern. So I had to change my view there. Some people become a little uncomfortable when you first say that, it's headed higher and then turned down. But if you do it at the right time, I don't really see the problem, except that the behavioral aspect, which is getting yourself to act rightly when you have to. If you have to change something, then you should have the capability to do it. Now, most people want you to put out something that they can stick by, and they want the easy road. But markets are never going to be easy. That's why there's something known as passive investing and active investing. That if you're an active manager, you have to think about moving in, out, making a little changes, but also keeping the big perspective at the back of your mind. So does that loss of momentum really mean that something has changed in the larger degree trend? And the answer to that was no. All it meant is that you're getting a pullback, and if you're getting a pullback when it comes to trading, at least those who are traders, trading positions usually need to be held back, or you need to wait for a pullback to really get in again, maybe get out of long trades that were standing out there. And that's where the importance of that kind of an opinion change comes in. But keeping the bigger perspective helps you stay along as an investor. If you're an investor and you're longer term in nature, then you don't really bother about short term corrections. And like I said right at the start, individual stocks have gone through a meaningful consolidation. So one of the signals that we got early on right into the second week of October was that even as the market was retesting the 12,000 mark for a second time, we got intermarket divergences, which means the Bank Nifty made a higher high than the Nifty itself made on the 12th of October. Similarly, mid-cap indices also made a higher high relative to the 12th of October. So both of these indices were actually diverging from what the Nifty was doing, and that non-confirmation can sometimes be a sign that, near term, at least within the time horizon of those divergences, you can get a correction or a pullback. And that's what we ended up seeing. Not much of a dip in the mid-cap index, not so much in the Bank Nifty either, because the Bank Nifty only pulled back to the 20 DMA. It's the Nifty that did the deeper cut, and I was expecting that. I was looking for that 38% retracement back to around the 11,550 mark. Only thing is it took time to come, because the first dip didn't get there, then it pulled back, made a double top, and then slowly came back to that support level. And having done so, at the end of last week, it looked like that correction was complete. I again started to, expect that the next wave higher could start, which is what we are seeing not just in Indian but US equities as well. So even the US index, I published the Dow chart, which shows a clear ABC decline from where this rally has started. And this rally started ahead of the US election news. And so the seasonal pattern has been that at least in the last 3 elections, and in fact in a dozen, if you look at a dozen of previous election events in the US, maybe there are 1 or 2. Most of them end up seeing the market actually go flat to down. And the most interesting one is, of course, the Trump election, the 2016 election, because, sentiment has been very, very similar this time around, just like it was the last time, except with one difference, that last time people were fearing Trump coming back, and this time people were fearing Biden coming in. It's very, very surprising how sentiment really changes over time. because if I spoke to someone in the US, like I speak to my brother who's there, he would say, in 2016, you'd hear that Donald Trump, if he comes to power, then the stock market is going to crash. And it was not, that's not what he was expecting, but that was the general narrative everywhere because of things that he was talking about, like maybe trade wars will be back. He's going to put a wall across Mexico. And in that sense, people ended up, overlooking what else he was saying, which is he was also saying that he's going to do tax cuts. He's going to, bring in other reforms that would actually have been positive for the markets. But still, for whatever reason, the markets drifted down, and the Trump crash that everybody was expecting when he comes to power lasted for not more than a couple of hours. So after that, the market turned around and then rallied for the next entire year. That's what we saw in 2016. And so this time, sentiments turned its boat. Now people were expecting that, well, if Trump doesn't come to power and you end up getting Biden, then the market's going to crash. And actually, by correcting ahead of the event, what has ended up happening is the market ended up discounting that possibility, which is why the last couple of days, or even this morning, when you saw leads in favor of Biden, you would have actually seen the markets pick up. So it started to pick up irrespective, because that whoever comes to power, it doesn't really matter when it comes to financial markets, because both are going to either spend money or stimulate. They've all announced plans to come out with another fiscal stimulus, then go ahead with further infrastructure spending. And that entire line of thinking that, the government has to step in and spend, because monetary policy alone that has been, holding the markets up for the last 7 to 8, 9 years can no more continue to do the same task. And so the government needs to step in. That's been, more or less the theme that we are moving towards over the last 1 to 2 years. And now, post the pandemic, I think most governments have decided to move there, and the US most aggressively. So if those are the plans of whoever comes to power, then it didn't really matter who really comes in. Though the fear that some had, that Biden would be more socialist, you'd put more taxes. He'd also announced, raising the capital gains tax. And if you asked me 2 days ago, I would say, well, a lot of governments say a lot of things, but they don't end up doing everything. For example, even last night in my conversation, again with my brother, I would say, I actually ended up asking him, I said, well, if people are fearing Trump, where's the wall? Where's the Mexican wall? And he was supposed to put up a wall. Maybe technically some will say, oh, there is something, but, you also had trade wars. Where's the trade deal? So you've had some deal, you've had some movement, but a lot of all those things which the markets usually get worried about, like war with Korea, for example, don't really end up happening. So every politician has certain cards that they play. Just go back and look at the Modi election a year back. They announced several taxes on HNI investors, and what ended up happening is it stayed around just for approximately not more than 3 months. So within 3 months, those taxes were rolled back and things moved back. So that would have been my argument probably a few days back against those potential measures. But what we are seeing right now is, as far as all those risks were concerned, most of the election results are almost out for the US. So we've had an entire month of uncertainty because the markets were flat ahead of the event, but we haven't really seen what I would call a crash. It looks like a long consolidation phase, and now that the consolidation is over, you will see the momentum come right back. I think that's the takeaway. And we've spent this time, the waiting game is probably over, the uncertainty phase is over, and now it'll be very, markets will just follow the tune that, whoever is coming to power is now going to be, taking steps towards the next plan, which is, more stimulus and probably the fiscal spending on things like infrastructure. Of course, it may take a couple of months, but markets always move ahead based on expectations. The other thing which has been happening is a lot of data points that we've gotten out of India, at least for the growth bouncing back so far, is actually starting to look good, at least based on the numbers that have come out, over the last week or so. Just today, I looked at the services PMI numbers bouncing back. So you have the service sector doing well. You have capital goods numbers coming back, and last couple of days you also got GST numbers going right back where they were more than a year back. In fact, making even higher highs, which shows that business is rebounding to levels people didn't think would actually happen because we've opened up the lockdown. So what's been the big fear? The other big fear that has been spooking the markets all of last week was that what about the second lockdown? Can there be a second lockdown in the country? Because many parts around the world have been seeing a second wave, and there may be a risk of another lockdown taking place. Now, again, those expectations also, when you really dig deeper into it, were actually unfounded, because I wrote a detailed analysis on that on Saturday, because I too was wondering, am I right thinking about this or not? And when you dig into it, what at least what my initial evidence that I got shows is, first, and let's just start with the US, the death rate in many places, whether it's the US or in Europe, has actually not been going up with these new case counts that are showing up everywhere. So that can mean one of two things: either the virus itself is not that fatal anymore, or second, you can say there's been good improvement in how medicine is really treating the virus itself. So everybody's more prepared, the medical system is more prepared, and so they're able to address that fact. Now, some of the lockdowns that are there also, they're not shutting down the entire economy. They're just probably trying to control social movement, because things like having a night lockdown or a night curfew ensures that people don't go out and spend time at pubs where the virus can spread more. But more importantly, what the data really showed is that a lot of these new spikes are happening in areas where you did not have a spike before. So the trend is really one of complacency. So, for example, in Maharashtra, Mumbai, for example, people would be more careful because the case spikes were very, very high. Everybody, went through some kind of discipline in what they should be doing, and so everybody's really wearing masks and moving out. Of course, you can find people who are less complacent, but at large, you would say people are taking care, and especially businesses that are running, offices that are running, shops, all of them are taking care to make sure that they follow certain discipline to avoid the spread of the coronavirus. So where are the case spikes really happening? So even if I look at India or I look at US. So in US, it's really not happening in New York. It's not happening in California. It's happening in places like Tennessee, Illinois, completely places where you didn't have big spikes earlier. You're seeing, bigger numbers. I would think the same is probably true for Europe. I've not drilled into, whether it's the same cities or not. But when you look at a map of India, okay, and this chart, which I pulled out from the web, shows Maharashtra peaked long ago and has been declining ever since. But in between, you got a spike up in Karnataka. So Bangalore, you've been hearing, a lot of cases happening over the last month or two. And that's because, that's where another wave was going on. That wave peaked in the second week, first to second, around the 10th or 12th of October. And that wave has been going down. But now all of a sudden you see it in Kerala. Kerala numbers were still rising when I wrote that report into the weekend. You also see it happening in West Bengal. So places where case counts are very, very low are suddenly jumping up because people probably think the lockdown's gone, everything is normal, and they are not taking the same kind of precautions as they are doing in other states that faced the severe part of the crisis. So the message clearly is that, yes, be careful wherever you are. That's, I think, the message of the end of looking at all that data, that the cases may not be jumping everywhere. Places where people had not seen it before and are more complacent is where it's happening. And then those numbers adding up at a country level are showing big jumps for some countries, but not every country is seeing a second wave as of now. So to expect that everything's going to shut down might not be exactly the right way to look at it. So unless we really see a problem at a national level, or a rebound happening in states that have already faced the music, I think what you're only seeing is normalization at a bigger level, which eventually leads you to what they call herd immunity. Now, of course, you cannot get immunity for everyone. There's some people who are going to fall sick, and even once you get a vaccine, what I'm told is that it's only going to help you treat better, and probably recover better. But it's after all going to be a virus, and it's going to go away on its own time. So it could be 1 year or 2 years before it slowly dies down through mutation. That's the actual way it's really going to work. So that's as far as the fears of the virus is concerned. We are done with the US elections, and now what we are going to be looking at is simply the momentum in the market, the actions of governments on both fronts, both reforms and stimulus. In India's scenario, I'd really want to see them move faster on things like disinvestment. If the economy is beginning to pick up again, and you have global flows available because there's a lot of liquidity sitting on the sidelines around the world, looking for places to invest, then the best thing that the government should do is follow up now on its plan that it announced in the month of May to start disinvesting public sector units, which many of them are actually available at very, very good valuations. Because when you see the PSU stocks, they've actually been beaten down, even though the market has rallied. The recent corrections have actually seen the PSU, many PSU stocks make new lows or at least go back and retest their previous lows or retrace maybe 80% of the gains that they were making. And in doing so, many of them are actually at very high dividend yields. You have dividend yields of 9%, 10% in some of these public sector units, which makes it very, very attractive. And it's a reminder of me of what used to happen in the 1990s, that every time the government used to announce that they want to sell public sector stocks, people who are holding them and want to buy a larger stake would sell, bringing down the price and, pushing the government to really sell at a, lower price so that they can get a larger stake at a throwaway price. So I don't know whether that's the game. It's a game they played eventually end of the, 1990s. Many disinvestments got postponed, but eventually for money, the government did end up doing a few, and then those sales happened at very good prices for those who were buying. For example, IPCL going to Reliance after the stock crashed from 200 to 100. Similarly, Tata's taking over VSNL and so on. Many of those deals happened that way. But question is now what happens this time around. So I think when markets are good, government should simply move fast. Something they always end up waiting too long. And then, by the time they actually take action, the markets end up being troubled or they don't get the price that they're looking for. But right now, valuations are really good. I mean, apart from whether government disinvests or not, I feel these are levels at which these stocks, given the dividend yields, have very, very limited downside. That's how I think about public sector units. So they can be limited downside, and the upside completely depends on whoever's going to bid and at what price is going to buy it out, and if the buyer is a significant major player in that sector, how he's able to get the company to really generate greater growth or profitability in the long term, and how he really restructures the entire business, and so that would provide further upside on a long term basis. So pretty good things that can actually come out of this. Overall, of course, when you look at simply a Nifty P, you may feel that the markets are extremely valued, which is where the risk is and which is where fear is. But what you are really playing here initially is the liquidity game. We can get into a deep argument as to whether growth really comes back by all these measures that are being taken both by us and around the world. So for liquidity, the one factor that you always watch is the dollar. And the dollar, which had been bouncing back, has today in the last few days had some big volatile moves. In fact, just 2 days ago, after pulling back, it sold off yesterday night pretty sharply. Would have looked like the next decline has started, but the event was not done, and so today morning once again it rallied back, taking back all those losses, making a minor new high, and then giving up all over again. And last I checked, I think before starting to record, it had already fallen to a new low. So that's probably on the expectation that Donald Trump's finally making it back. And once the dollar starts its decline or its descent, once again you'll see liquidity being available or coming back to emerging markets. We haven't seen huge flows into India yet, and that is why I spent some time discussing on our need to really move fast, because we are in a good position to really attract some of that liquidity and use it in the right way. So that's, I think, the overall setup. We are done with a lot of the uncertainty, and whatever moves that governments take and they do should really drive the movement of markets from here on. Of course, markets are going to be forward looking, which means that they're going to expect that a lot of what is being said will actually get implemented. The big failure would actually be if that doesn't happen. And the next is going to be that, once they implement, can you actually get earnings visibility by the year end? Because if by Jan or by March of this year, you're not able to see visibility and markets keep going higher, then at some point of time they'll get too overvalued and could actually end up seeing a steeper correction, something that we've really not seen up to this point of time. The reason we are probably not seeing it up to this point of time is there's still a huge valuation divergence between segments of the market. So while you look at a Nifty P, it may look expensive, but if you look at individual mid-cap stocks, some of them, and like I said, PSUs among others, may actually end up looking cheap. So money actually tends to rotate from sectors that are looking strong versus sectors that are looking weak, and those which are expensive versus those which are cheap, and all that rotation is still keeping the markets hot as of now. But if everything gets expensive, that would be a completely different story. You can expect, therefore, some sectors, for example, FMCG is one that I've written about, to actually underperform because it ended up closing the year down for 2019, and that made me feel that maybe it's completed a 5-wave upward move on a long-term chart all the way starting from 2002, and if it has done so, it could probably go into a long consolidation phase just like it did in the 2000s. I mean, for those who remember, 2000 to 2005, I think Hindustan Lever just did not participate in the initial moves of the market because it was the best defensive bet of the previous period in the 2000s till the tech bubble ended, and other parts of the economy were not doing well. So those sectors attracted all the money. And when all the other sectors started to attract money, then the defensive sectors like FMCG actually ended up underperforming. In fact, even the pharma sector in that sense was underperforming at that point of time. But right now we of course see a divergence between pharma and FMCG. So I would say pharma, because it's been through a 4-year bear market, is actually picking up and has started its own new bull phase. Whereas the FMCG sector, which was outperforming till last year, may actually go into a long consolidation phase where I don't think it will make new highs yet. You may see it in large trading ranges up and down as the market gyrates both ways. But in general, it will be a consolidation rather than in a bull run, is what my sense is as of now, unless something changes. And so that's where, sectors that have, extreme valuations could actually underperform, go into a consolidation, whereas those which are, not been recognized, fallen a lot because of the 2-3 year bear market, and individual stocks might again start getting attention. And that's where I think the whole opportunity lies. And, once we are done with this move, again, we will revisit the idea whether valuations are too high or is there earnings visibility to really, say that, these valuations can be justified. So that's all in this update for you today. Look forward to doing another one, hopefully by next week. Thank you.